So did you know that 8 out of 10 entrepreneurs are going to fail in the first 18 months of starting a business because they run out of cash? We talked about that last week. Here's a few other interesting statistics. 90% of businesses are gone by year 10. 90% of all business owners don't really know how to read a financial statement. Perhaps there's a link to all that. Let's talk about that today in relation to your self-storage business. My name's Mark Helm. I'm the author of Creating Wealth Through Self-Storage, and I'm the creator of the Quick Start Academy. And what the Quick Start Academy does is it houses the training I have, both free and paid for, that supports the small investor who wants to get in the self-storage business or who wants to grow their self-storage business, do so strategically in a way that creates true wealth and a fulfilling career. And last week we talked about what your P&L doesn't tell you about. And it doesn't tell you about cash. What does it talk about? Well, it talks about profits. Profits and cash, it turns out, are two different things. You can't spend profits. You can only spend cash. And to get a little deeper in the weeds, your P&L really doesn't even tell you exactly what your profit is. It literally gives you the theory of what your profit is. Yeah, I had to learn. It turns out profits and cash are not the same thing. I mean, let's think about it. Let's take a fictitious storage facility. You earn $50,000 a month in rent. Your operating expenses are $20,000. Your profit's $30,000. So when it comes time to make your mortgage payment, you look at your profit and loss statement and you say, I got $30,000 in the bank. You go to make your mortgage payment and you don't have $30,000 in the bank. Where'd it go? I don't know. According to my financial report, I made $30,000. Reason is, profit and cash are not the same thing. Your P&Ls, again, are focused on profits, not cash. Your P&Ls are actually focused on the theory of what your profit is. So let's dive a little deeper into this, and then let's talk about how to actually track your cash. So your P&L is like a snapshot. Whatever time period, it could be a day, a month, a week, a year, whatever. Let's talk about a monthly snapshot. Whatever the profits are at 11:59 at the end of the month, that's what the P&L reflects. It's a snapshot of 11:59 p.m. at the end of the month. Now, let's start with expenses. It turns out that just because an expense is on your profit and loss statement, that doesn't necessarily mean it's been paid. The vast majority, if you have a bookkeeper, it's accrual system. In other words, when the bills come in, they go into QuickBooks or whatever software you're using. At the second they're entered, now they are an expense for that time period. And if you think about it, it makes sense. Otherwise, if you just take your bills and set them in a drawer, when you look at a financial statement, you don't know what your real expenses were for that month. And if you set them in a drawer, eventually you're going to forget to pay them. So when expenses come in, the vast majority of the time they're entered in QuickBooks or whatever software you're using, and at that moment they become an expense. Now, that doesn't necessarily mean they've been paid. I mean, think about your property taxes. Yes, you may set aside some cash, but you're not paying your property tax. You pay your property tax once a year. Some operating expenses are paid with cash. You better pay your utility bills with cash, or they'll cut your lights off. Other expenses are paid, you give yourself an IOU. You may pay it with a credit card, where you've got to pay that credit card bill at a later time period, another time period, using that time period's cash, or you accrue it and set it aside, but you can pay either cash or with an IOU that you give yourself. Yet all of them are expenses in that time period. And for most self-storage owners, even their income isn't all received. Some storage owners will only input income as they get the money. If you have a bookkeeper, odds are your income's going to be entered when it's due. If you create invoices in QuickBooks for your customers, the moment that invoice is created, that's income. Doesn't mean you have the income, but it shows up as income. If you think about it in theory, and what a profit and loss statement is, that makes sense. Why? Well, because if you don't enter your income and your expenses, how do you really know whether your business in theory should be making a profit? So you can give a customer an IOU for their income. You don't really issue an IOU, but when they don't pay you, it's an IOU. It goes into accounts receivable. When you give yourself an IOU on the paying your expenses later, that goes into accounts payable. They show up on a balance sheet. They don't show up on a profit and loss statement. We'll talk about balance sheets next week. They were always a big mystery to me. Now, don't get me wrong, your profit and loss statement is an important theory. It's important to know if you're profitable. I just learned the hard way, you don't spend profits. You only spend cash. So it turns out there's another very important report that can come into play. And I always have to ask for it. When I ask for the financials on a project I'm looking at, I never get this report. When I ask my CPA for a financial report, I have to ask for this report. They don't give it to me. And that's the cash flow statement. Did you know QuickBooks or almost any operating system will generate for you a cash flow statement? You would think if you're in business and cash is the blood, the lifeblood of your business, you would get a cash flow statement. Well, the reality is your CPAs are not very interested in your cash. Your CPAs are very interested in your profit because you pay taxes on profit. And it's important to know what your profit is so you can develop appropriate tax strategies with your CPA to minimize your taxes on the profits. But your CPAs really don't care about your cash. You care about your cash, they don't. The real health of any business is your ability to turn profits into cash. And there's actually a report that will tell you about your cash over a given time period, your cash flow statement. Now, it turns out all cash is not created equal. There are, in business, 3 types of cash. There's operating cash, there's investment cash, and there's financing cash. Now, which cash do you think is more important? Well, I'm sure you guessed it. Let's talk about it right now. As you guessed, operating cash is the most important kind of cash in any business. Operating cash is the cash you receive from selling your services, or in the case of a self-storage facility, renting your space, selling retail items, renting trucks, anything you do to generate income. That's operating income, operating cash. Now, most of us use our operating cash to pay our operating expenses. Now remember, those expenses can be paid in cash, or you can issue yourself an IOU and pay it in a later time period. So there's operating cash, most important cash in your business. Then there's investment cash. Most of the time, investment cash is income that would come in when you sell stuff and things that are on your balance sheet, not in your services and your products. We'll talk about your balance sheet next week, but on your cash flow statement, which shows up under investment cash, would usually be the sale or the purchase of what your CPAs would call PP&E, property, plant, and equipment. And the third type of cash there is financing cash. And that is cash that's made or spent with banks and investors. When investors give you money, that shows up on your cash flow statement in that time period. When you pay a dividend to your investors, that shows on your cash flow statement that's going out as negative for that time period. So your cash flow report will show operating cash, investment cash, and financing cash. In essence, here's what it looks like. For whatever time period you're looking at, you're starting with a certain amount of cash. Then your operating cash either goes up or down during that time period. Your investment cash either goes up or down, or very often stays neutral. And your financing cash will either go up or down, and then there's an ending cash position. So your P&L is like a snapshot at the end of whatever time period you're looking at that talks about profits. Your cash flow statement's more like a movie over that time period, showing money, where you started, where you ended, and how the money flowed in and out of your business during that time period. Now, giving cash is the most important thing to a business owner. Why in the world isn't this what we always have to ask for it? This is the most important report that I look at monthly. Doesn't make any sense to me. As a business owner, you can't make a lot of informed decisions on profits. Yes, you can help design strategies to minimize taxes. That's important. But you can make a lot of informed decisions based on your cash position. Most of us don't know what our cash position really is. We just maybe go online and check what's in our bank account, and that's our relationship to our cash position. That's like looking at the top line of a balance sheet each and every day. Ain't gonna give you important information to have, but it sure ain't gonna help you make a lot of educated business decisions. Fortunately, we're in the self-storage business. Storage generates a lot of cash, a lot of operating cash, and it generates it, once you're stabilized, it generates it pretty consistently and pretty ongoingly. Yes, there's ebbs and flows depending on what's going on in your trade area, but all in all, especially compared to any other kind of real estate investment, storage is by far the most steady on the amount of cash you end up with. Why? Well, because there's just less variables hitting your cash position. If you think about what we talked about last week in the office building, there's no commissions, there's no tenant improvements to make. The few capital improvements you're going to make, those are pretty predictable. You know when they're going to happen. There's very few surprises. Once you're stabilized, there's not a lot of surprises in the self-storage business. Now, next week, we'll look at the balance sheet and my relationship to the balance sheet, the profit and loss, and the financial statements. They're each like scorecards, and you got to kind of tie them all together to get a real picture, and we'll talk about that next week. So thank you very much. My name's Mark Helm. I'm the author of Creating Wealth Through Self-Storage, and I'm the creator of the Storage World Analyzer. That's the financial analysis tool we use as we're looking at what the cash flows are going to be on a new project that we're considering putting in service or we're considering building. Have fun, pull up a cash flow statement for the end of the month or quarter or whatever period you're in right now, or look at the last time you got a report and pull up a cash flow statement for that time period and look at that next to your profit and loss statements in your balance sheets. Next week we'll tie them together. I look forward to being with you then.